Good day, investors. In this video, we're taking a closer look at SoFi after its Q1 earnings. Now, this was a strong quarter. Revenue growth was impressive, profitability continues to scale, and full-year guidance remains very strong. But despite that, the stock actually went down after earnings. So the big question is, what is the market seeing that investors might be missing? So in this video, we'll break down the numbers, the business model, and the key growth drivers, and whether SoFi stock is still an attractive investment right now after the pullback. But before we begin, don't forget to leave a like for the YouTube algorithm and subscribe to the channel for more investing videos. All right, let's start with the quarter itself. SoFi reported record-adjusted net revenue of $1.1 billion, up 41% year over year. Adjusted EBITDA came in at $340 million. That's a very strong 31% margin. And the company generated $167 million in GAAP net income, marking the 10th consecutive profitable quarter. So profitability is clearly scaling now. This is no longer a turnaround story. This is a consistently profitable business. Now, if we look at member growth, we can see SoFi continues to scale at a very strong pace. The company added about 1.1 million new members in the quarter, bringing total members to over 14.7 million, and products to more than 22 million. But what's really important here is the consistency. You're seeing around 35% year-over-year growth. And over the longer term, members have grown at about a 38% compound annual growth rate, while products have grown at around a 37% compound annual growth rate. So this clearly isn't slowing down. The platform is still scaling very quickly. And this matters because more members and more products per user ultimately lead to higher monetization over time. Now, one thing I really like here is the quality of revenue. SoFi generated about $1.1 billion in cash revenue in Q1, which is essentially in line with total revenue. And you can see this trend. Cash revenue has been 95% or more of total revenue consistently. So this tells us the business is generating real, high-quality cash earnings, not just accounting-based profits. Now, another important trend here is that SoFi's revenue is becoming more diversified. Fee-based revenue continues to grow and now makes up around 36% of total revenue. And this is important because it reduces reliance on lending income and makes the business more stable over time. So as SoFi scales, the quality and predictability of earnings should continue to improve. SoFi has also been improving its profitability. You can see margins expanding very consistently. Adjusted EBITDA margin has increased from around 9% to 31% over the past few years. And that's a very strong improvement. It shows the business is scaling and that SoFi is generating operating leverage as it grows. SoFi has also been delivering strong returns. The company has now achieved 10 consecutive profitable quarters, and you can see earnings improving steadily, with adjusted EPS reaching around 12 cents in Q1 and expected to grow further. At the same time, tangible book value has grown to over $9.2 billion, which shows the company is building real underlying value. And returns are also improving, with return on tangible common equity now around 7.6%, up significantly from negative levels just a few years ago. So this isn't just growth. It's a clear shift toward a more profitable, scalable, and higher quality business model. Now, another part I like here is the financial services segment. You can see it's delivering around 41% year-over-year revenue growth. And importantly, a large portion of that is coming from non-interest income, which is growing even faster. So this is things like fees, interchange, and platform revenue, not just lending. And at the same time, margins remain strong, around mid-40% to 50% range. So this segment is not only growing quickly, it's also high margin and increasingly important to the overall business. Now, if we look at the lending segment, you can see it's still delivering very strong growth, with revenue up around 53% year over year. And this remains a highly profitable segment, with contribution margins reaching around 61%, which shows very strong profitability. So lending continues to be a major driver of earnings today. But at the same time, SoFi is gradually building out other revenue streams alongside it. Now, if we look at the technology platform segment, this is the part of SoFi that provides infrastructure to other financial companies. Revenue did decline this quarter, dropping from around $122 million in Q4 to about $75 million in Q1. But this segment tends to be more volatile, and it's still a relatively small part of the overall business today. So short term, you may see some fluctuations, but long term, this remains a key growth opportunity. So after looking at the segments, now looking ahead to guidance. The company is guiding for around $4.6 billion in revenue for 2026, which implies roughly 30% growth year over year. At the same time, adjusted EBITDA is expected to reach around $1.6 billion, with margins expanding to roughly 34%. And earnings are also expected to grow significantly, with net income projected around $825 million and EPS around 60 cents for the year, which points to a strong forward outlook. So after looking at the key figures, if we step back and look at the bigger picture for SoFi and the long-term opportunity here, what I really like is the direction the business is heading. The story is really about growth drivers and expansion. SoFi is moving far beyond just lending and building out a broader financial ecosystem. You can see that through new initiatives like SoFi Pay, crypto, business banking, and AI tools like SoFi Coach, as well as the expansion of its technology solutions platform. And this is important because it creates more ways to engage users and more ways to monetize them over time. At the same time, SoFi is still relatively early, with a small market share across most of these areas, which means there is still significant room to grow. So when you combine all of this, you have multiple long-term growth drivers that could continue to support strong growth going forward. And going a step further, this is where SoFi's model becomes really powerful. The company calls this the financial services productivity loop. The idea is simple. The more products a user adopts, the more engaged they become. And the more engaged they are, the more products they use over time, which increases lifetime value per customer. You can already see this working, with cross-buy reaching around 43% in Q1. So this creates a self-reinforcing cycle that can drive growth and improve profitability over time, showing the strength of SoFi's business model and its long-term potential. So after looking at the earnings numbers and fundamentals, let's now take a look at analyst expectations. According to stock analysis data, the consensus rating is currently a buy, with an average price target of around $24.43, which implies roughly 57% upside from current levels. At the same time, there's a fairly wide range of estimates, with targets ranging from about $17 on the low end up to around $37 on the high end, indicating a potential upside of over 130% at the top end. So overall, analysts remain optimistic, but there is still some uncertainty around the outlook. Now, if we take a look at the stock itself, SoFi is currently trading at around $15.53 per share, giving it a market cap of roughly $20 billion. And as you can see, the stock pulled back quite significantly after earnings, down over 15% on the day. Looking at the bigger picture though, the stock has been quite volatile and is still well below its previous highs. It's also trading relatively close to its 52-week lows, which could indicate a potential buying opportunity at a lower valuation compared to previous levels. At the same time, the business itself continues to grow and improve profitability, while the stock has pulled back, making the current setup quite interesting. So when we bring everything together, SoFi just delivered a very strong quarter. The company has now achieved 10 consecutive profitable quarters. Revenue continues to grow strongly, and margins are now above 30%, showing clear operating leverage. At the same time, member growth remains very strong, with 1.1 million new members added, bringing the total to 14.7 million. And product adoption continues to scale. So the business is clearly moving in the right direction. So in my opinion, SoFi is no longer just a high-growth fintech story. It's becoming a scaled, profitable, and more diversified business, with multiple growth drivers across lending, financial services, and technology. And when you combine that with the recent pullback in the stock, I think the market reaction could actually be creating a very interesting buying opportunity. Because from a long-term perspective, the fundamentals still look very strong. And if the company continues to execute, I remain bullish on the long-term potential here. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.